What if the silver price you're seeing on your screen is basically a ghost? While the real price just quietly broke $100 at major dealers, the financial networks are doing their usual ticker parade. Green here, red there. CNBC is chatting about tech stocks. Bloomberg has another talking head explaining why markets are resilient, but there's this eerie silence about what's happening right now in the metal sector. Before we go further, if you want clean, no-hype breakdowns like this, subscribe and turn on notifications so you don't miss the next update when this story moves again. I've been a private commodities analyst and a physical silver stacker for over a decade, and I built this channel with this AI avatar for one main reason. I'm tired of spending half my day digging through mainstream coverage just to confirm what I can already see in real time on my feeds. And honestly, I'm tired of other AI channels pumping fake hype about silver when retail investors need real information, not drama. So here's what they're not telling you. A criminal investigation was launched into Jerome Powell, chairman of the Federal Reserve, the man who controls the money printer. And I'm not talking about a soft review or some ethics committee slap on the wrist. The Department of Justice is investigating him over his 2024 congressional testimony and some office renovation expenditures that apparently raised red flags. The media is trying to frame this as a minor volatility event in the metal sector. They're telling you the Fed is still independent, still in control, still the steady hand on the wheel, but the physical silver market just told you something very different. American Silver Eagles, the benchmark 1-ounce coin every stacker watches, just crossed $100 at major dealers. Not the spot price. The spot price is sitting at $85.55. I'm talking about what you actually had to pay to get physical metal in your hand. $100. That's not a typo. That's not a quick spike. That is the new floor for physical silver, and it formed in roughly 48 hours. For the first time in my career, the gatekeepers are being investigated by their own Department of Justice, and the physical market basically called their bluff. The Fed opened Pandora's box, and I don't think they're going to like what's inside. Here's my primary claim. I'm going to spend the next hour proving it with data, math, and real market mechanics. The DOJ's criminal probe into Powell has shattered the illusion of Federal Reserve independence. That break in trust triggered a massive safe haven flight into hard assets, and that wave caused physical silver to completely decouple from the paper exchange. We are no longer trading a commodity. What if the silver price you're seeing on your screen is basically a ghost, while the real price just quietly broke $100 at major dealers? The financial networks are doing their usual ticker parade. Green here, red there. CNBC is chatting about tech stocks. Bloomberg has another talking head explaining why markets are resilient. But there's this eerie silence about what's happening right now in the metal sector. We are trading a crisis proxy. I'm going to walk you through what I call the premium gap mechanism. I'm going to run the stress test math on these $100 Eagles. And I'm going to show you exactly how I'm positioning my personal portfolio to survive what looks like a shadow war between the Federal Reserve and the Department of Justice. And if you think $100 is the ceiling, you haven't seen the data I'm about to show you. Because there's a rumor circulating on institutional desks right now about something called the LBMA short squeeze. And if that rumor is even partially true, we're not talking about $100. We're talking about $150 in hand, while your screen still flashes $100. Let me give you the snapshot. I pulled this data a few hours ago at 2 p.m. Eastern Standard Time. Gold hit 4,610.54. That's a new all-time high. Silver spot closed at 85.55, up over 7% in a single session. That is a massive one-day move for silver. But here's where it gets strange. While spot was printing 85.55, I opened up APMEX, and then I checked across major dealers in the United States. Brilliant uncirculated American Silver Eagles had been moved to $100 or higher. Some listings were at $102, $105. Smaller regional dealers were even higher because they were scrambling to restock from wholesalers who were already out. Beat. Stop for a second. Look at that gap. Paper price says 85, physical price says $100. That's a 17.5% premium. In a normal market, premiums on Silver Eagles are usually $3 to $5 over spot, maybe $8 if supply gets tight. 17% is not tight. 17% is a divorce. Now here's what really caught my attention. Inventory. I have a contact at a mid-sized dealer in Texas. He told me this morning that his weekend order volume was 4 times normal Saturday traffic. People were buying anything they could get. Eagles, maples, generic rounds. It didn't matter. They just wanted physical silver before the psychological barrier of $100 scared them off. So why is the physical price moving so much faster than the screen? Because of a mechanism most investors don't understand. And if you don't understand it, you're going to get fleeced by headlines over the next few weeks. Let me pull this apart. The key mechanism here is physical versus paper decoupling. I call it the premium gap. This is the split between the futures contracts traded on the COMEX and the physical metal you can actually hold. These are two different markets. They're supposed to track each other, but they don't always. And right now, they're not even in the same zip code. Here's the simple definition. The spot price you see on financial websites is derived from the COMEX futures market. That's a paper market. It's a contract that says you have the right to take delivery of silver at a certain price on a certain date. But most of those contracts never result in actual delivery. They're basically wagers on direction. Traders close them out before expiration. It's a casino, and the chips are paper. Physical silver is different. Physical silver is what you buy from a dealer, what you hold in a safe, what you can't create with a keystroke. There's a finite amount of it. It has to be mined, refined, minted, shipped, stored. It has mass, it has scarcity, and when everyone wants it at the same time, price has to rise until enough people finally say, no thanks. Think of it like this. Imagine the official price of a concert ticket is $85 on the venue's website, but when you go to buy it, the site says, sold out, everything is gone. Now, if you really want to get in, you have two options. You can wait and hope the venue releases more tickets at $85, or you can go outside the stadium where scalpers are selling tickets for $100. That $100 is the real price. The $85 is just a ghost number on a screen that no longer matches reality. That is exactly where we are with silver right now. COMEX is telling you $85, but if you try to buy physical at $85, you'll get laughed out of the shop. The real price, the price you actually pay to acquire metal, is $100. And here's why that becomes a trap. If you only watch the ghost price on the news, you'll never understand why your local coin shop has no silver left. You'll see spot dip to $80 next week and think, great, silver is cheaper. But the dealer will still be charging $95 or $100 because physical supply hasn't returned. The paper market gets held down by institutional players who benefit when the price stays low. But the physical market is doing something else entirely, price discovery. It's showing you what silver is really worth when people want to hold it, not just trade it. And that gap is growing because of a rumor leaking from institutional desks right now. I heard it from two separate sources, both tied to market firms you've heard of. The rumor is this: a major London Bullion Market Association vault is staring at a delivery default. The buyer could be a sovereign wealth fund or a central bank placing a massive order for physical silver. And the vault can't deliver. They simply don't have the metal. In other words, paper claims were sold on silver that wasn't truly there. And now someone has called their bluff. We can't verify the rumor. I don't have a source inside the LBMA. But the premium explosion we're seeing lines up with what a delivery squeeze looks like. When institutions realize they can't secure metal at paper prices, they go straight to the physical market. And that's when retail investors like you and me get priced out. Now let's run the math. I'm going to lay out two scenarios, a conservative one and a stress test. You decide which feels more likely. Conservative scenario. Let's assume the premium gap stabilizes around 17.5%. If spot silver keeps climbing and hits $100, math says physical eagles would price around $117. You'd pay $117 to get a 1-ounce coin that your screen says is worth $100. Stress test scenario. If the LBMA short squeeze rumor is true and institutional delivery failures escalate, premiums could hit 50%. I know that sounds insane, but it has happened before in other commodities during crisis conditions. A 50% premium on a $100 spot puts physical silver at $150 in hand. You'd be paying $150 for a coin while your TV keeps saying the price is $100. The relative strength index for silver is at 77.9. That's overbought territory. Historically, when RSI moves above 70, it's often a warning that a pullback is coming. Traders see that and think, sell, take profits, wait for a dip. But physical demand doesn't care about technical indicators right now. The RSI is screaming overbought, and dealers still can't keep inventory on shelves. That tells me this isn't a normal technical rally. This is a fear-driven accumulation event. People aren't buying silver because they think it's going to $90. They're buying silver because they think the financial system is cracking. Here's another data point that doesn't fit a normal environment. The US dollar index, the DXY, is showing resilience. It's not collapsing. Normally, when the dollar is strong, precious metals get crushed. That's the inverse relationship everyone learns in Econ 101. Strong dollar equals weak gold and silver. Weak dollar equals strong gold and silver. But right now, both are rising. The dollar is holding. Gold just hit an all-time high. Silver is up 7% in a day. That shouldn't happen unless this is not a standard currency trade. Unless this is a liquidity black hole event. Money is fleeing into anything that feels safe. Dollars, gold, silver. The numbers don't match the history books because the history books never priced in a Fed chairman under reported investigation. That's the variable no one accounted for. The Fed's independence was always a myth. It kept the system stable because people believed the Fed was above politics, above corruption, above reproach. That belief is gone now, and once trust disappears, price discovery turns violent. So let me tackle the strongest counter-argument head-on. Skeptic argument number one, this is a politics-induced blow-off top. The RSI is stretched. Once the DOJ headlines fade and the investigation turns out to be nothing, silver will crash back to $70. This is just retail hype fueled by fear-mongering YouTubers. Here's my rebuttal. I would agree with you if this were purely retail-driven. Retail can't move markets of this size. Retail doesn't have that kind of capital. But this is not just retail. I saw a Morgan Stanley research note that came out Friday. Their entire commodities theme flipped to stick with metals. They are now telling institutional clients to buy silver as a fiscal risk hedge. When big banks start telling clients to buy the thing they usually tell them to avoid, the floor moves higher. Morgan Stanley isn't a silver permabull. They care about making money for clients. If they're rotating into metals, it's because their risk models are flashing red. Let me myth bust another idea while we're here. The idea that higher rates always mean lower gold and silver. That's the story you'll hear on CNBC. The Fed raises rates. Gold and silver fall because they don't pay yield. Cash and bonds become more attractive. Go back to 1979 and 1980. The Volcker Fed raised interest rates to 20%. 20. And silver ran to its all-time high of $50 an ounce during that exact period. Why? Because the market didn't trust the Fed. Rate hikes were seen as proof inflation was out of control, not proof the Fed had it under control. The market was front-running the chaos. We could be in a similar setup. If the Fed hikes rates this year to try to restore credibility, it might do the opposite. It might signal they're panicking. And if the DOJ probe continues, every rate hike can look like a desperate attempt to save face. We've seen the $100 physical breakup. We've defined the premium gap and why it's a divorce between paper and physical. We've looked at the DOJ investigation and why it's a trust event, not just a political sideshow. Now what comes next? Here's what I'm watching. Institutional reaction, specifically the COMEX. When the paper market starts losing control of price discovery, the exchange does what it always does. It hikes margin requirements. That forces retail traders who are long silver futures to either post more cash or close positions. It's a way to shake out weak hands, and it works. Every time they hike margins, you get a temporary dip as traders liquidate. I expect the COMEX to announce a margin hike within the next week, maybe two. If they do, spot silver will probably pull back to $80 or $75. The financial media will say, see, the rally is over, silver is crashing. But if you understand the mechanism, you'll know the paper dip doesn't automatically mean the physical price is following. Dealers might reduce premiums slightly, but the $100 floor is likely sticky now. I'm also watching the gold to silver ratio, the GSR. That's the number of ounces of silver it takes to buy 1 ounce of gold. Right now, with gold at $4,600 and silver at $85, the ratio is about 54 to 1. Historically, the long-term average is around 60 to 1. When the ratio drops below 50, it's usually a sign silver is outperforming gold. It means silver mania is starting. If we see that GSR break 50, I'm expecting a face-melting rally in silver, the kind of move that gets normies asking their financial advisors how to buy coins. That's when it gets dangerous, because premiums can go parabolic. 40% or 50% isn't unthinkable in a panic. First, expect coordinated silence. Major networks won't cover the silver story because it's inconvenient. It raises questions about Fed credibility, central bank manipulation, and the stability of the financial system. Then when they do cover it, they'll call silver a meme metal. They'll compare it to GameStop and AMC. They'll bring on an analyst who claims this is retail speculation driven by social media. They'll do everything they can to discourage the masses from buying. And that's exactly when you should pay attention, because the media's job is not to inform you. Their job is to manage your behavior. Now let me tell you about the wild card scenario. I call it hike to spike. There's an unverified rumor that the Fed might hike rates aggressively this year, not to fight inflation, but to crash the economy and undermine the DOJ investigation. The logic goes like this. If Powell is facing criminal charges, his best defense is to prove that removing him or weakening the Fed would be catastrophic for markets. So he engineers a controlled crash, blames it on political interference, and uses the chaos to rally support. I can't verify it. If it is true, we're entering extreme volatility. Rate hikes would crush equities and real estate, but they might send gold and silver higher as people flee into hard assets. The playbook gets messy. So in this chaos, what am I doing with my own money? Let me give you my personal battle plan. This is not advice. Do your own research. Trigger number 1, the 80-50 support test. If spot silver retraces to 80-50 and holds, I see that as structural confirmation to stay aggressive. It means the rally has legs. Dip buyers are still in control. If it breaks below $80 and keeps falling, I'm going to lighten up. I'm not trying to catch a falling knife. Trigger number 2, the 25% premium cap. If the physical premium hits $106 while spot stays at $85, I'm sitting on my hands. I refuse to pay a 25% panic tax to dealers. At that point, the risk reward is broken. I'd rather wait for premiums to compress or for spot to catch up. Trigger number 3, the GSR at 50. If the gold to silver ratio hits 50, I'll look to rotate a portion of silver gains back into gold. Not because I'm bearish on silver, but because I want to lock in profits and rebalance. Silver is more volatile than gold. When it runs hard, but when it dumps harder. I don't want to be the guy holding the bag at the top. I'm not buying the ghost price. I'm not making decisions based on what the screen tells me. I'm watching global shop availability. If supply vanishes completely, price becomes irrelevant. You either have it or you don't. And if you don't have it when the system breaks, good luck getting it at any price. I'm using conditional if-then logic. If the Fed caves to the DOJ and Powell resigns or gets removed, expect a short-term dip in metals as the market interprets that as resolution. If the Fed fights back with rate hikes and tries to weaponize monetary policy, I'm holding for the long haul because that would be final proof the system is broken. Let me recap where we are. The allegation of a DOJ probe opened Pandora's box for Jerome Powell. That shattered the illusion of Fed independence. Physical and paper silver decoupled. $100 is the new real floor for American Silver Eagles, even though spot is $85. We've explained the premium gap mechanism. We've run the math on conservative and stress test outcomes. We've addressed the skeptic arguments. Now, I want to take you deeper into historical context, because if you don't understand how the Fed has intervened in metals markets before, you won't recognize the playbook they're about to use. Go back to 1980. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, tried to corner the silver market. They bought physical silver and silver futures contracts. At one point, they controlled almost half the world's deliverable silver supply. Prices went from $6 an ounce in 1979 to $50 in January 1980. The establishment panicked. The COMEX and the Chicago Board of Trade changed the rules mid-game. They banned new long positions in silver futures. They hiked margin requirements. They implemented delivery limits. All of it was designed to force the Hunts to liquidate. And it worked. Silver crashed from $50 to below $11 in a matter of weeks. The Hunts went bankrupt. Here's why that matters now. The Fed and the exchanges have a playbook. When the price of silver starts threatening the system, they change the rules. They don't let the market run free. They intervene. And they always justify it as protecting market stability or preventing manipulation. If we see a repeat of the Hunt brothers dynamics, you need to know what it looks like. First, margin hikes on the COMEX. That's already on the table. Second, delivery restrictions. The exchange might say you can only take delivery of a certain amount of silver per month. Third, coordinated media attacks. The financial press will say silver is a bubble. It's irrational. It's being manipulated by retail speculators. The goal is to scare you into selling, and it works on most people. They see the price drop 20% in 3 days and think, I need out before it goes to zero. But if you understand the playbook, you recognize the dip can be artificial, not driven by fundamentals, driven by rule changes designed to break the rally. Now let me contrast what's different this time. In 1980, the Hunts were trying to corner the market for profit. They were speculators. The Fed could paint them as villains. But in 2026, the buying isn't coming from two billionaires. It's coming from sovereign wealth funds, central banks, pension funds, and retail investors who are terrified of what the DOJ investigation implies for the dollar's stability. You can't easily paint that as manipulation. You can't claim middle-class people buying Silver Eagles are cornering the market. The demand is decentralized. It's global. It's driven by a collapse of trust in the system. That makes it much harder for the Fed to intervene without looking like they're rigging the game. There's also a geopolitical angle. I'm seeing reports that China and Russia have been accumulating gold and silver reserves for years. If they smell blood in the water, if they believe the U.S. financial system is weakening, they could accelerate accumulation. That would squeeze physical supply even more, and it would turn the silver market into a proxy battleground for a much larger economic war. I also want to address the international context. The U.S. isn't the only place dealing with a crisis of confidence in central banks. The European Central Bank has been under fire for years. The Bank of Japan is trapped in a zero-rate policy and can't escape without threatening the bond market. China's economy is slowing. The whole global monetary system is under stress. And when central banks lose credibility at the same time, the flight to hard assets becomes a stampede. It's not just Americans buying silver. It's Europeans, Asians, Middle Easterners, anyone with access to a dealer trying to get physical metal, and supply is finite. There's only so much silver mined each year, only so much inventory available for delivery. That's why I don't think physical paper decoupling is a temporary glitch. It's the new normal. As long as trust in central banks is broken, the premium gap persists. You pay more to hold physical than to trade paper, and that premium is the price of certainty in an uncertain world. Let me add another layer to the COMEX intervention playbook. It's not only margin hikes. The exchange can also implement position limits. That means they cap how many contracts any single entity can hold. The stated reason is preventing manipulation. The real reason is preventing large players from forcing delivery. If you own 10,000 silver futures contracts and each contract is 5,000 ounces, you have the right to demand delivery of 50 million ounces. That's a lot of silver. If the COMEX doesn't have it in their vaults, they're in trouble. So they cap your position at, say, 1,000 contracts. Now you can only demand 5 million ounces. Huge, but more manageable. Watch for position limit announcements. If the COMEX suddenly announces new limits on silver futures, it's a signal they're worried about a delivery squeeze. And ironically, that's bullish for physical silver, because it's the exchange admitting indirectly that the paper market is fragile, the strategic petroleum reserve. The U.S. keeps a reserve of crude oil for emergencies. What if the government decides to create a strategic silver reserve or a strategic precious metals reserve? They could justify it as national security. Silver is used in electronics, solar panels, and weapon systems. If there's a supply shortage, it can threaten infrastructure. If the government starts buying silver to build a reserve, that's game over for the bears. Price goes vertical, because now you're competing with unlimited fiat currency backed by the full faith and credit of the United States. You can't outbid that. I don't think it's likely in the near term, but it's on the table. And if the DOJ investigation escalates and the Fed's credibility collapses, the government may feel pressure to do something dramatic to restore confidence in the dollar. Announcing a precious metals reserve would be one way to project strength. Now let's talk supply. Silver is unique because it's both a monetary metal and an industrial metal. Roughly half demand comes from industry, electronics, solar panels, medical devices, water purification. The other half comes from investment and jewelry. In an economic slowdown, industrial demand should drop. That's bearish. But in a monetary crisis, investment demand can surge. That's bullish. So, which force wins? Right now, it looks like investment demand is overpowering any slowdown in industrial demand. But that could change. One thing to watch is solar. Solar panels use silver paste in photovoltaic cells. If there's a solar boom, physical supply tightens further. If solar subsidies get cut or the industry slows, it frees up silver for investment demand. Most silver is mined as a byproduct of other metals: copper, lead, zinc, gold. Only about 30% comes from primary silver mines. That means silver supply is not very responsive to price. If silver doubles, you can't just open new silver mines overnight. It takes years to develop a mine. That inelastic supply is bullish if demand surges. The market can't quickly bring more silver online, so price has to do the work. It has to rise until enough marginal buyers say, that's too expensive. And with a monetary crisis dynamic, I'm not sure where that clearing price is. It could be $150, $200, or higher. Weimar Germany, 1923, hyperinflation, the currency collapsed. People were burning money for heat because it was cheaper than buying firewood. In that environment, physical goods became the store of value. Silver, gold, real estate, tangible assets. The U.S. is not Weimar Germany, not yet. But the loss of confidence in the Fed is the first step on that path. If people stop believing the Fed can control inflation and protect the dollar, demand for hard assets accelerates. And silver, because it's more affordable than gold, becomes the primary vehicle for middle-class savers trying to protect themselves. That's the demographic driving this rally, not the ultra-rich. They're buying gold, art, real estate. It's the middle class. People with $50,000 or $100,000 in savings who are terrified of it being inflated away. They can't buy 10 ounces of gold at $4,600 each, but they can buy 100 ounces of silver at $100 each. It's accessible, it's tangible, it's insurance. Now, what happens if the Fed tries to pivot and cut rates? Let's say the DOJ investigation fizzles. Powell survives. The Fed cuts rates to juice the economy. In a normal world, that's bearish for the dollar and bullish for silver. But we're not in a normal world. If the Fed cuts rates after this crisis, it will look like surrender. It will signal no credibility, no independence, no control. The market will interpret it as weakness. That could intensify the flight to hard assets. So even a dovish pivot could push silver higher. That's the trap the Fed is in. They're damned if they hike, damned if they cut, damned if they hold. The only way to restore credibility would be for the DOJ investigation to end with Powell fully exonerated and the narrative shifting to "the Fed saved us again." I don't see how that happens. The damage is done. The cat is out of the bag. People are questioning legitimacy. And once you open that door, you can't really close it. Here's my forecast for the next 3 months. I think we're going to see volatility. Sharp moves up, sharp moves down. The COMEX will hike margins. Media will call it a bubble. Retail will panic sell. Institutions will buy the dip. Then, price rips higher again. By March, I expect spot silver to test $100. By April, I expect the physical premium to compress slightly as dealers catch up with inventory, but the $100 floor should hold, and as long as the DOJ investigation is still ongoing, I expect another wake-up. Could be $120, $135 physical, could be $150 plus. The risk is the black swan, something nobody is pricing in. War, a debt crisis, a currency collapse outside the U.S. that triggers contagion. If that happens, all bets are off. Silver could go to $200. You could also see government emergency orders, capital controls, export bans. There's precedent. In 1933, the U.S. government banned private ownership of gold. They could do the same with silver if they feel threatened enough. I don't think it's likely, but I'm aware of the risk. That's why I don't have all my net worth in silver. Diversification matters. I have some gold, I have some cash, I have some real estate. Silver is my crisis hedge, not my entire portfolio. Now let me talk about the psychological warfare you're about to face. Financial media will try to break your conviction. They'll bring on analysts saying silver is overvalued. They'll show charts with bearish technical patterns. They'll interview people who bought the top in 1980 and lost everything. The message will be clear. Don't be that guy. Sell now before you lose it all. You need to decide right now whether you're trading or holding. If you're trading, you need stop losses and profit targets. If you're holding as insurance against a monetary collapse, you must ignore the noise. You can't do both. You can't say you're holding for the apocalypse and then panic sell on a 10% drop. I'm in the holding camp. I'm not trying to time the market. I'm trying to survive a systemic breakdown. That means I'm okay with big drawdowns. I'm okay with the price dropping temporarily because I'm not measuring success in dollars. I'm measuring in ounces. If I have 100 ounces today and I still have 100 ounces next year, I won. Dollar price is irrelevant if the dollar's collapsing. A trader wants to grow capital in dollar terms. Buy low, sell high, repeat. I respect that approach. It's just not what I'm doing. I'm insuring against a world where dollars don't matter anymore, or where they matter so little that holding them becomes a guaranteed loss. Now let me give you practical tips for buying physical silver. First, know your dealer. Not all dealers are equal. Some have been around for decades and have strong reputations. Others are fly-by-night operations that vanish when markets get volatile. Stick with established players: APMEX, JM Bullion, SD Bullion, Provident. Second, compare premiums. Don't buy from the first dealer you find. Check multiple sites. Sometimes the difference is $5 or $10 per coin. Over 100 coins, that's $1,000. Third, understand products. American Silver Eagles are the most recognizable and liquid, but they carry the highest premiums. Canadian Maple Leafs are nearly as good and usually cheaper. Generic rounds are the cheapest, but harder to sell. Bars sit in between. Know what you're buying and why. Fourth, secure your stack. Don't tell people you have silver. Don't post pictures online. Don't brag. You make yourself a target. Buy a safe, use a private vault service, or bury it. Just don't leave it in a drawer where any burglar can grab it. Fifth, plan your exit. At some point, you might need to sell for cash, for an emergency, or because you hit a profit target and want to rotate. Know where you'll sell. Local coin shops often give the best price. Online dealers buy back, but take a bigger cut. Private sales can work, but carry risk. Now let's talk international supply chains. Most silver comes from Mexico, Peru, China, and Australia. If geopolitical disruptions hit any of those regions, supply tightens further. Mexico has cartel violence. Peru has political instability. China is opaque. Australia is stable, but far away, and shipping is costly. If silver becomes a strategic asset and governments start hoarding it, export restrictions could appear. China could ban silver exports. Mexico could add tariffs. That would send prices higher because the U.S. would be competing for a smaller pool of supply. Here's a thought experiment. Imagine silver hits $150 spot. At that level, behavior changes. People start melting old silverware, jewelry, anything with silver content. Recycled supply floods in. Dealers suddenly have inventory again. Premiums compress. Price stabilizes. Is that the top? Or just a pause before the next leg up? I don't know. But I do know $150 feels like a psychological level where the market shifts. Below $150, silver still feels normal. Above $150, it starts feeling like bubble territory. I'm okay with the price dropping temporarily because I'm not measuring success in dollars. I'm measuring in ounces. If I have 100 ounces today and I still have 100 ounces next year, I won. Dollar price is irrelevant if the dollar is collapsing. A trader wants to grow capital in dollar terms. Buy low, sell high, repeat. I respect that approach. It's just not what I'm doing. I'm insuring against a world where dollars don't matter anymore, or where they matter so little that holding them becomes a guaranteed loss. Now let me give you practical tips for buying physical silver. First, know your dealer. Not all dealers are equal. Some have been around for decades and have strong reputations. Others are fly-by-night operations that vanish when markets get volatile. Stick with established players: APMEX, JM Bullion, SD Bullion, Provident. And bubbles attract attention: media, regulators, politicians. Once silver becomes a political issue, the dynamics change. Government could intervene. The Fed could coordinate with Treasury to dump silver from stockpiles. That's why I have triggers. I'm not married to silver. I'm married to the strategy of preserving wealth. If the strategy says sell, I sell. If it says hold, I hold. I don't let emotion or ego decide. Let me also address counterfeit risk. As price rises, counterfeits become more profitable. Fake coins, fake bars, tungsten-filled fakes that pass weight tests but fail purity tests. It's a real problem in gold, and it's coming to silver too. How do you protect yourself? Buy from reputable dealers. Get a Sigma Metalytics tester if you're buying large quantities. Or pay for assay services. The last thing you want is to discover your stack is fake when you try to sell. I've seen estimates that 5% to 10% of physical precious metals on the secondary market are counterfeit. That's terrifying. It means if you buy from a random guy on Craigslist or a sketchy online seller, you could easily get scammed. Stick with big players. Pay the premium. Now let me tie it all together. The DOJ probe allegation around Jerome Powell is not just a political scandal, it's a credibility crisis. It's the moment the curtain gets pulled back and people realize the wizard is just a man. The Federal Reserve's power has always been built on perception, that they're independent, that they're competent, that they're above corruption. That perception is shattered, and when perception breaks, price discovery gets chaotic. Overvalued assets crash. Undervalued assets surge. Silver was undervalued for decades because the paper market suppressed price. The physical market is now correcting that suppression. $100 isn't the top, it's the beginning of a repricing. I've been in this market for 12 years. I've seen rallies and crashes. I've made money and lost money. But I've never seen a setup like this. Fundamentals, technicals, sentiment, geopolitics, everything is aligned for a sustained move higher. That doesn't mean it goes straight up. It means the trend is your friend until it isn't. My battle plan is simple. Hold the core position, trade around the edges, take profits on volatility, reinvest in dips, stay disciplined. Don't get greedy, don't get scared. This is a marathon, not a sprint. Here's my rallying cry. We are watching the death of central bank independence in real time. The Fed opened Pandora's box when they thought they could keep the illusion forever. But the DOJ just called them on it, and the physical silver market is the canary in the coal mine. It's telling you something is broken. It's telling you the paper game is failing. It's telling you that if you want protection, you need to hold something real. Don't let the screen lie to you. The screen says $85. The dealer says $100. The dealer is showing you reality. The screen is showing you a fairy tale. Trust the physical world. Trust the local shop. Trust the fact inventory is drying up and premiums are exploding. Those are signals. And if you ignore them because the TV says everything is fine, you may be the one left holding worthless paper when the music stops. You need the historical context to see where this is going. I covered the 1980 Hunt Brothers squeeze in a previous video. That's the playbook the Fed might use to try to stop this rally. If you haven't watched it, go find it. Because the strategies they used then are the strategies they'll try now. Except this time the buying is decentralized. This time demand is global. This time they might not be able to stop it. The clock is ticking, premiums are widening, inventory is shrinking, institutions are positioning, and the retail wave hasn't even started yet. You're early. I know where I was. I was watching the data, reading the vault reports, talking to contacts on institutional desks, buying physical silver while premiums were still manageable. And I'm sharing this because retail investors deserve the same information institutions have. We're not second-class citizens. We're not dumb money. We're just people trying to protect what we earned. So that's the full picture. The DOJ probe story opened Pandora's box. Physical silver decoupled from paper. $100 is the new floor. The premium gap is real and widening. The playbook says the Fed will intervene, but this time may be different. The math says higher prices are coming. Sentiment says the retail wave hasn't started yet. So my plan is to hold the core, trade the edges, and stay disciplined. Stay sharp, stay informed, and trust physical reality over the paper illusion. I'll see you in the next one.